Private credit isn't a new asset class. It's been around since the early 2000s, but it's a new asset class to most investors. So let's go over a few of the basic terms. All right, this is pretty straightforward. We're just making loans to companies. We are the lender here, the private credit lender, making a loan to the borrower, the company, in exchange for interest payments that comes back to us. And sometimes there's points or fees in exchange for making these loans. Loan to value. This is just like the loan to value on your house that you might have bought, where you have a mortgage that might have been 80% of the home's value. Here, when you're lending to companies, the loans are often much lower in terms of the percentage. So it's often 50% or lower in terms of the loan to value. And that's because you want more safety. You want more cushion if you're making a loan to a company as opposed to real estate. So here you have the lender, that's us, the sponsor company. The sponsor might be a private equity firm that is buying this company. And then you have over here in this fancy little triangle block thing, you have the company with its 50% debt, the loan that we just made, and of course the equity below that. And that is the total enterprise value of this company, is the debt and equity. All right, capital structure. This is one of those things that sounds complicated, but it's actually pretty easy. It's just, how do you capitalize a company? How do you put money into a company in order to make it work, either to purchase it or to buy new equipment, what have you? Companies need capital. This is the capital structure, and it represents the priority on claims of the company, on the cash flow of the company. Here we have the common equity. That's just like common stock that you could buy on the stock market. You have preferred equity, and that might be your limited partners in the deal. Maybe if you purchased a company and you had to raise investor capital, they're going to want some sort of preference above your equity in the company. So these two blocks are equity. Then you go up here into the debt structure, and the higher you go, the safer it gets. Mezzanine debt often has pretty high coupon rates. It's a lot like preferred equity in terms of a risk standpoint. But as you get up here to senior secured debt, this is typically what we focus on. And so in the unlikely scenario that the company fails and can't repay its debt, the lender comes in and the senior secured lender then goes off and sells the assets to recoup its loan. And then if there's anything left over, then the unsecured debt holders get something. If there's something left over, then the mezzanine debt lenders get something. And so as you can see, this is a waterfall down, where often the equity doesn't get anything. It's often zero because the debt lenders took everything and there wasn't any money left over. And of course, this is why debt is so much safer than equity, because even if you have a default where the borrower stops paying you your interest payments, you can still take over the company, sell the assets, and recoup your principal, or at least a large percentage of your principal. And next we have call protection. And that just means, hey, if you're going to make a loan and it's 10% interest rate today, you would rather not have the borrower pay you back in 3 months and say, oh yeah, I don't need the loan really anymore. Here you go. If you're going to go through the trouble of underwriting the loan, spending the time to get to know the company, sending people out there, underwriting the assets, you don't want to get that loan back really quickly. You want to have 3 to 7 years is often the typical loan period. And so in order to make sure that you have some protection, is that oftentimes lenders will say, hey, you cannot pay this loan back within 3 years. Or if you start paying it back early, there's prepayment penalties. And often those are points or percentages above the loan to get the lender whole, so to speak, for having to get that capital back, that loan back earlier than the lender might have planned. Covenants, another fancy term. It just means restrictions. It just means that, hey, if we're going to make a big loan to this company, we don't want the borrower to go out and remodel his house or buy a new RV. The loan has to be used for certain things to improve the company, to improve the collateral that the lender has in that asset. So you want to see it go towards new ways to bring in customers. You don't want to see it used haphazardly. And then you want to put restrictions on how much additional debt that company can take on. And you want to make sure that they are making enough money to cover, to have a spread, a big spread above what your debt payments are. Profit of the company, debt payments, right? You want that to be a healthy spread. Otherwise, if that gets too narrow, you as the lender are going to be checking in on the company and saying, hey, wait a minute, let's start getting quarterly or monthly updates on what's going on here. And let's start making sure that our collateral is safe. And if they break that covenant, if they dip down below that spread, the lender might actually step in and start operating the company to ensure that it's collateral, the assets of the company, and its loan are safe. If you made a loan to somebody and they stopped paying you, or they were getting really tight on their interest payments, you'd be more interested in what they were doing. And these are a nice feature with private loans, because with syndicated loans or bank loans, oftentimes you're not getting as many covenants. The lender is not as involved with the underlying company. They make the loan and they just, hey, send me the checks. Whereas in private credit, the lender and the borrower have more communication. There's more opportunity to save loans before they get too troubled and before they default. So a nice feature of private credit. All right, so those are the basic terms. At the end of the day, once again, we're just making loans here. It's not that complicated, but there are some unique features to private credit that most investors aren't used to. And so hopefully that made sense and had some educational value for you. Thanks for listening.